Marc Faber predicted the 1987 stock market crash, and along with many other spot-on calls, told us back in early March that stocks would rally and industrial metals would outperform gold. Of course, that is exactly what happened. Marc, managing director and founder of Marc Faber Ltd, is best known for being the editor and publisher of the Gloom, Boom, and Doom report. He's in our Seoul bureau this morning. Marc, always great to have you. Lately, you've been sounding the alarm about monetary policy, how central banks won't be able to turn off the tap, and low interest rates and money printing will lead to spectacular inflation, not to mention a weak dollar. What I want, though, is to explore with you the implications for investors. So let's start with what this means for equity markets.
Well, I think what it means for equity markets is that we've probably and most likely seen a major low on March 6, 2009, when the S&P hit 666. And here in Asia, most markets actually bottomed out in October, November of last year. So I think that what will happen, let's say, for one reason or the other, the S&P, which then went to 956 and is now at 920, if it drops again towards 800, I'm sure there'll be another stimulus package and another massive monetary injection. And if that doesn't help, then another one will come when the S&P drops towards 700. So I don't think we'll see new lows. And I also believe that the economic recovery will be relatively disappointing, with the government sector expanding as the government sector has already expanded in the last 10 years. It's basically the government that is creating jobs, and the private sector is hardly creating any jobs. And that stimulus will be very hard to take away. And so I believe the fiscal deficits will not come down next year and in 2011, but actually go up.
Okay, so Marc, if we're not going back to new lows, but at the same time the economic recovery is going to be disappointing, what does that mean for corporate profits? What does that mean for stock market valuations? Where could things go over the next 12 months?
Well, what it means is you don't want to be in cash, because obviously when you have zero interest rates, as you have now on bank deposits and treasury bills, you're not going to earn any money. On the other hand, you may not lose that much. But basically, there's a lot of cash on the sidelines in treasuries and in deposits that eventually can move into the one or the other asset class. It may not move into bonds, because obviously the bond market over time will also smell some inflationary pressures and the depreciation in the value of the dollar. So where does the money flow? It can flow into some precious metals like gold, silver, platinum, and maybe palladium. But it will also flow, obviously, into equities, because basically equities in an inflationary environment have some value in the sense that the replacement cost then is exceeded by higher and higher costs to replace essentially the existing plants and manufacturing capacities. So I would say, in general, in inflationary times, the one thing you don't want to own is cash and bonds, and equities is more desirable, and I think that gold is probably the preferred asset.
Marc, hang on one second, because we have more to ask you about. We want to talk a bit more about gold. We want to ask you about currency. So Marc Faber staying with us while we go to break, and he'll be back with us on the other side.
All right, we're back as promised in just 2 minutes.
We're back with Marc Faber, editor and publisher of the Gloom, Boom, and Doom report. He joins us from Seoul this morning. Marc, I want to ask you about gold. You just said that gold looks attractive as a hedge against inflation, but are you in the camp with some other investors and strategists who see energy as a good hedge against inflation as well?
Well, right now, and I'm talking here for the next 4 to 6 weeks, I think the dollar could recover somewhat. I think bonds could rally somewhat. I think industrial commodities could come under pressure, and gold probably kind of move sideways or also come under some pressure. So that's a near-term call. I think longer term, the situation is different. Longer term, I look for essentially a weak US dollar, and for strengths in commodity prices, and of course also gold. and the relative outperformance of Asian shares vis-a-vis, say, European or U.S. shares.
Mark, all of this is predicated on the fact that you see the U.S. in a hyperinflationary state. I mean, you compared us to Zimbabwe in July 2008. Do you really think it's going to be that bad? I mean, honestly, on a scale of 1 to 10, you actually have zero confidence in the U.S. government's ability to exit?
Yes, that I have zero confidence, absolutely zero. There's no political will to reduce the deficits and to keep money tight. And if you read all the articles that are published essentially in the United States, and if you read the statements by Mr. Bernanke, they all point towards essentially keeping interest rates artificially low and at all costs to generate some inflation. Now, the problem with inflation is not that you can just generate 3 or 6% inflation. Inflation is a dynamic process, and I can assure you, all of the viewers of Bloomberg, they will be hit this year with higher contributions to the government and higher insurance premiums for their insurance policies and so forth and so on, higher transportation costs. I don't know, the deflation is what prices they are living by, but my prices in life, they go up.
All right, that is Marc Faber, Managing Director and founder of Marc Faber Ltd, editor and publisher of the Gloom, Boom, and Doom Report. Marc, always great to have you. We look forward to having you back soon.